And if you're not familiar with it, be sure to pay attention. Okay? So here we go. First, what trading is all about when it comes down to the basic form is really just four things. It's your share size or risk per trade. It's your batting average, the Sharpe ratio, and number of trades that you take per day, per week, per month, whatever you're trying to measure. Whether, okay? So it's the frequency of your trades. That's it. Those are the four things that are under your control that will directly impact the bottom line. I'm going to show you how. So just make sure to stick around. Let's talk about the first one though, share sizing. And let me give you the formula for it. Of course, if you've been in the room with me for any period of time, you know the formula. But I learned this from Van Tharp, from his book called How to Trade Your Way to Financial Freedom. It's an amazing book, but really boring. And it's like 450 pages long. And that was the first time that I heard about risking a constant amount. Not just buying the same share size. Like I used to buy, 500 shares of everything, or 1,000 shares of everything. And I don't do that anymore. I have a formula that I follow religiously on all my trades. So this is just an example of actually a pullback, a buy setup with a 20-cent stop. Entry at 44.18, stop at 43.98, and the target at 45. So here's the numbers. And so you figure out the stop size is 20 cents. If you want to risk, so figure out how much you want to risk per trade. How much you're comfortable risking per trade. And then take that amount, which should be the same on almost every trade, and divide it by the stop size, which is the difference between the entry price minus the stop price. So $100 risk divided by 20 cents gives you 500 shares. If we were to change the risk to $500, obviously the share size will increase fivefold as well. From $100 to 5, that's 500 divided by 20 cents, that's 2,500 shares. If you were to go to $1,000 risk, same thing, it doubles, right? That's the formula, the easiest thing in the world. But it's not that easy to follow if you're not disciplined, or if you allow yourself to get emotional, right? Now we'll get to it. We'll talk about it in more detail in a few minutes. But what about the reward to risk? Can we calculate it? Yes. The reward is the difference between the target price minus the entry price. The risk, or the stop, is the entry minus the stop price. So that's the reward zone, and that's the risk zone. So the reward would be the target, 44.98. So 44.98 minus 44.18, 80 cents, divided by the stop size, which is the difference between the entry minus the stop, 20 cents. That gives you a reward to risk of 4-to-1. That's important. Okay, we need to know what the reward is on every trade before we take the play. Oh, the relay trade, the RELY triggered. I mean, I know it triggered earlier for you, but it triggered for me now. RELY. Okay. So that's the reward. The calculating the reward to risk. I mean, where's my cursor? Here it is. Okay. We talked about this already. Now, in order to make it really easy for you to to calculate the share size without having to take out a calculator and do all that math, you can put together a cheat sheet, a share sizing table, which the same exact table that I'm projecting right now has been uploaded in an Excel spreadsheet form to the files in this room, which you can download. This way you can just print it and tape it to your monitor or your desktop. So basically in this case, for $1,000 risk, it calculates, I can tell what the share size should be based on the stop size. So of course 1,000 shares divided by 5 cents, 20,000 shares, right? 6 cents, 16,600. Well, I may not know what 1,000 divided by 6 cents is, without using a calculator. In this case, it does the math for me, right? And then as the stop gets bigger and bigger, then you can start to create a range. So from 23 cents to 28, it's 3,500. It's not going to be exactly $1,000 risk, but about the same. Close enough. The idea is we want to risk about the same amount on every trade. We don't necessarily need to risk the same exact amount, but about the same amount, which is $1,000 in this case. Now, $1,000 might be a lot. You can use $500 risk. You just change the risk unit, and the table updates automatically. This table also is rounded to the nearest 100 shares. So the formula that I used in Excel rounds to the nearest 100. And here's $100 risk. Okay? Not rounded in this case. Or is it rounded? It is rounded. Up until this point, then you can't round. Okay? Does that make sense? So, yeah, FVRR looks good short. It's a little bit strong, but FVRR may be a short. Okay, so this is the easiest thing in the world. Again, following it might not be the easiest if you allow yourself to get emotional. So that's how to calculate the share size. All right, but we'll talk more about it later. Now, questions for you. How much should you risk on a trade in general? Should you risk 100, 1,000? What does it depend on? Like, what's the talk is about to trigger, guys? The TALK might trigger. What does it depend on? Your mortgage. Should you share size based on the quality of the play or the conviction? Meaning, the plays that you really, really like, you take a really big size on. The plays that you don't like as much, you don't take as much size. It makes sense, doesn't it? Yeah, it depends on the setup. But let me ask you something. Let's say you found a really good setup. Let's say you found a really good setup and you decided to take big size. I don't want to say you decided to mortgage the house on it, but you decided that this is a really good setup. And you took big size, big risk, 10,000 shares, however much, okay? Most of the time, trades don't go straight up or down. They don't, they don't move in a linear way. They go up and down, right? A little bit at a time. Would you be able to manage it well if you had a huge size in it and it started to go to get wiggly a little bit, to go up and down? Would you? Probably not. You'll be watching it like a hawk. You'd be worried about it like crazy. Exactly. So this is why you should not share size based on conviction, because this is the problem, is that the really good setups, it makes all the sense in the world. to do more size on. Makes sense. The problem is it messes up our psychology. And now all of a sudden, the good play that I was, that I felt really sure about, now I can't manage it. And now, why? Because I have all the size in it, and I'm really worried about it. So this is why share sizing based on conviction, unfortunately, doesn't work. Okay? You can cheat a little bit and do it. Sometimes I do it a little bit. Like I'll figure out a way to cheat my own psychology. Basically, I'll give you an example. On Bitcoin, a few months ago, I'll tell you when. Back in December. November, December. No, it was November for sure. Back in November. It's a play in the newsletter. So you can look at the newsletter and you'll see exactly when we entered. I knew it was, I felt this was it. I gotta get in and, I want to have really big size. I don't want to be risking $1,000 or $2,000 on something that could be a long-term play. But I knew if I just oversized it by a crazy amount, I would have a hard time managing it. So you know what I did? I decided to do $2,000, risk $2,000 on BITO, BITO, the ETF, and then also trade Bitcoin, the cryptocurrency, so BTC, $2,000 risk, and also did BITX, which is another ETF, a leveraged Bitcoin ETF, $2,000 risk. So I did risk $6,000 on it. But in order to help me, not worry too much about it, I took 3 different instruments and treated it like there are 3 different trades. Now, am I supposed to do, that's not, why did I do all of this? Why couldn't I just do Bitcoin? It sounds like I should have just bought Bitcoin or BITO or whatever. It's only because I didn't want to go through, I've been through that experience a million times, and no matter what I tell myself, if the stock starts to go against me and I'm risking a lot of money on it, I will start to worry about it, and I'll start to maybe micromanage it. So just to help with the psychology part, I cheated a little bit like this. You see what I mean? So you can cheat a little bit sometimes, but in general, you want to have a steady risk on every trade, in general. Now back to this question, how much should you risk on each trade? It really depends on at least 3 factors. At least 3. One is your account size. If you have a $10,000 account and you're trading with $2,000 risk on each play, or $1,000 or even $500, that's way too much. If you have a bad week, we all have bad weeks and bad months even sometimes, right? Bad days, you'll go bust if you end up with a bad day, bad week, bad month. So it should depend on your portfolio size or your account size. It should depend on your experience. Are you actually already profitable and have a lot of experience under your belt? And then the third factor is your comfort level. I've seen people that have all the experience in the world but they're still not comfortable risking over a certain dollar amount. You have to respect that. You have to honor that. Otherwise, you won't be able to do it. So that's what it depends on. At least these 3 factors. Okay? Is the stop size the number of points in the trade? No, the stop size is the difference. Did you miss the first part? I just went over it. The stop size is the difference between the entry price minus the stop price. That's the stop. So it's on the chart. It's based on the chart. So if we were to look at this chart, the entry was right here, the stop is right here, based on the chart, based on the pattern. So that's what the stop is, okay? regarding scalps and swings, is the stop the same? It's not. It's not. It's not the same. Doesn't have to be. You can have different risk amounts based on the strategy or the time frame. You can. So I'm not saying every single trade should be the same, but every single maybe swing trade or every single trade within a certain strategy you should risk the same amount on. Okay? So you can you can massage the numbers a little bit and figure out what works best for you. But overall, we just don't want to be risking based on how we feel at any given moment in time. We feel good, oh, let's risk more. We feel not so good about this play, let's not risk enough. That doesn't work. So based on feel, doesn't work. Okay? Now, a question for you. What is a good reward to risk ratio in general? We saw the example that I went over had 4 to 1. 4 to 1 reward to risk. This last example we looked at, right? Had 4 to 1. This one, 4 to 1. So what's a good reward to risk ratio? 2 to 1, 2 to 1. Anybody else? Wow, everybody's saying 2 to 1. How come? Now, it depends on your win rate. Okay. Okay, 20 to 1. All right. 1.5 to 1. Okay. Fair answers. But it really depends. It really depends. What's a good batting average? What's a good batting average? Anybody? Batting average is your win rate, your hit rate. %50 plus. Okay, let me ask you something. It does not depend on your risk, by the way. The reward to risk, maybe yes, does depend on your risk, but not the batting average. But anyways, we'll go over it in more detail. Now let me ask you another question. Frog, yes, triggered. Let me ask you another question. If a professional trader were to tell you their batting average is 50%, isn't that the same as random, like a coin toss? Isn't that the same? Wouldn't that be the same? I mean, if you just flip a coin, heads you buy, tails you short, over, and you flip the coin 1,000 times, wouldn't that give you 50-50? So the answer is yes. That's basically the same as random. So your batting average is like no good if you're batting 50% and you call yourself a professional trader, so-called professional trader. But that's not quite true, because if we take trades based on a flip of a coin and we average 50%, we end up with a 50% batting average. The problem with that is, the winners and the losers will probably be about the same. They will make or lose about the same. So you won't make any money. But if I told you that, yes, we average 50%, our batting average is 50%, but our reward to risk, or our Sharpe ratio, is 4 to 1, or basically the winners make 4 times as much as the losers. So it's 50% because we kill the bad plays quickly, and we even sometimes even the small wins, we don't even bother taking profit on them because we're hoping that they turn into big profits. But when on the ones that work, we make a lot. So that's the difference. When I used to tell people that, oh, my batting average is 58%, it depends on the strategies. I have 57, 58, and 62. So people would say, oh, wow, that's almost the same as random. It's not. It's not at all. Okay? All right. Continuing on. Here's the only four things that matter in trading. First one is reward to risk. Reward to risk is also known as Sharpe ratio. It's not exactly Sharpe ratio, but we'll get into what Sharpe ratio is shortly here. But your reward to risk determines your Sharpe ratio for the most part. Okay, I'm going to take a look at the RELY because I see that it's back down to the entry. Okay, I'll let it go. I'll let it be, but would have liked to have seen more follow through, but I'll let it be. Okay, on the RELY. Oh, talk triggered. You're right, talk triggered. Yeah, we'll see. Okay. So reward to risk, also known as Sharpe ratio. Again, it's not, but the reward to risk determines your Sharpe ratio. The formula for Sharpe ratio is average winner divided by the average loser. So the average winning trade divided by the average losing trade. How do you calculate the average winning trade? You take the total gains, total dollars gained, divided by the total number of winning trades. How do you figure out what the average loss is? Similarly, you take the total amount lost and you divide by the total number of losing trades. And that's how you figure out the Sharpe ratio, what the Sharpe ratio is. The second thing that matters in trading is batting average. Batting average formula is the number of winning trades divided by the total number of trades. So if you made, if you took 100 trades and you won on 60 of them, 60 of them made money, 40 of them lost money. You take 60 divided by 100, you'd have a batting average of 60%. Very simple, right? And then the third thing that matters is the frequency of your trades, the amount of trades that you do per day, per week, per month. If your expectancy is positive, if you multiply your Sharpe ratio by your batting average and it's over 1.0, then the more the better. The more trades you take, the better. But we'll get to it in more detail shortly. And then the last thing that is important is the risk per trade, the amount that you risk on each and every trade. These are the only four things that matter in trading. That's it. Nothing else matters. Now, you might say, well, what about commission? I'm assuming, we're talking about, first, it's a commission-free environment for the most part. But I'm talking about, when all said and done, what are your numbers on a net basis, not on a gross basis. So I'm talking about net basis here, not gross basis, okay? So Sharpe ratio, batting average, frequency of trades, and risk per trade. Let me show you how they work. Let me give you an example. Let's assume somebody has a Sharpe ratio of 2.0. A Sharpe ratio of 2.0 means what? Means the average winner is twice as much as the average loser. It doesn't mean they make, they make 2 R's on every trade. It doesn't mean they make, a certain dollar amount. Like they risk 100, they make 200. No, not necessarily. It just means they make twice as much as they lose on every trade. So a lot of times, let's say I risk $500 per trade, but my average loss is $250. Then to have a Sharpe ratio of 2.0, I would need to my average win to be $500, which is actually 1 R, right? Just 1 R. So let's say somebody has a Sharpe ratio of 2.0, a batting average of 60%, takes 6 trades a day, and risks $500 per trade. Here's what the table would look like. 6 trades per day, batting average 60%, so that's that. So 60% times 6, that's 3.6. So on average, they win 3.6 times, and they lose 2.4. Okay, since the Sharpe ratio is 2.0, that means they make twice as much as they lose. Whatever the loss amount is, they make twice as much. So 2 R's, 1 R, right? And then the total money made on the winning trades would be 7.2. The total losses would be 2.4. Net would be 4.8 R's per day. If the person was risking $500 per day, that's $2,400 a day. That's per week, per month, per year. When I first came up with this table, and that was in 2007, a long time ago, I was shocked at how easy it is to make a ton of money if you just, improve these 4 basic numbers, basically. Just four numbers. If we can improve any one of them, that excuse me, you could end up with a lot of money at the end of the year. So let me show you how these 4 things change the totals, how they influence the bottom line. If we go from 6 trades a day to 4 trades a day, that's a 30% reduction. I mean, 1/3 reduction, right, in the number of trades. So the bottom line goes down by also 33%, right? So you take 4 trades, averages, so 60% batting average, 2.4 minus 1.6, you end up with a net of 3.2 R's per day. So the total goes, so always remember this number. I want you to keep this number in mind. 575, let's just say. 576,000 per year. It goes to 384. The difference between the two is 33%. Okay? Now, if we were to change the risk, it also has a linear impact. I mean, on a like 1-to-1 basis. Look at the frog. Wow. Nice play if you took. FROG. Really nice play. Let's see over here. Yeah, very nice play. So if we were to double the size from 500 to 1,000, the 575 goes to now 1.1 million. 1.15, right? So it doubles. So again, you double the risk, you double the total amount made at the end of the year. See, take a look at what happens when your Sharpe ratio drops by 50 basis points, so 25%. That's a 25% reduction in your Sharpe ratio from 2.0 to 1.5. Wow. The total goes from 575 to 360. So that's a 37%, 38% reduction in the bottom line. And your Sharpe ratio went just from 2.0 to 1.5. So it has an exponential impact on the bottom line. Batting average, even worse. It drops by 10%. Okay, it's not 10% because it goes from 60 to 50. So that's, 10 divided by 60, that's 16% actually. But it also has, you end up with the same bottom line. You end up with $360,000 from so this is So 2.0, check it out, 2.0, 60% batting average, 576. 2.0, 60%, 576. 2.0, 50% batting average, 360. I mean, if that's not shocking, I don't know what is. You see what the difference is? Huge difference. Huge difference. So just a 10% increase or decrease in your, it's not, again, it's not exactly 10%, it's more. We missed out on the FVRR, by the way. FVRR, Frank, Victor, Richard. So that's goes to 360. So it's incredible. If you say, well, I want to improve my batting average from 50% to 75%, I would say you're not being serious. Okay? If you say, I want to improve it from 50% to 55, I would say you're realistic. Now you're serious. Because the difference between 50 to 60 is already huge. Just improve it by 5%, 10%, and see what impact that has on your bottom line. Incredible impact. Now, question, how can you improve your batting average? How do we improve batting average? Anybody? Take the best setups only. Screen time. Cut out bad setups and trades. So be more picky, choosy. Don't swing at bad pitches. Okay. Be more selective. By being more selective, which can reduce. So, right. So here's the so do we improve it by being more selective? Yes, we do. Absolutely. If you're not going to be more selective, you're just not going to improve your batting average. But that's not the only way to do it. The problem with being more selective is that if you're more selective, then you're going to reduce the amount of trades that you take during the day. And the amount of trades that we take during the day is one of the 4 factors that impact the bottom line. So if we become more really selective, and now we take, instead of 6 trades per day, we take 1 trade a day or 2 trades a day, and we improve our batting average from 50% to 70%. What's the result gonna be like? We're worse off. We would actually be worse off for having improved our batting average. So you do want to be as selective as possible, but without being so selective that you materially reduce the amount of trades that you take per day. Got it? So you can only improve it by being selective, by improving your technical analysis skills. So somebody said screen time. By actively improving your technical analysis skills, you take classes, you really are actively learning and studying and more, not just. And then the third way is it improves on its own with experience. That's what screen time really means, with experience. But the second point is, can you improve your technical analysis skills? And in order to do that, you can't just be doing the same thing every day, sitting in front of your screen, hoping that somehow now your technical analysis skills just got better. I see traders all the time that have been trading for like longer than I've been alive, and their technical analysis skills is terrible. Hasn't improved in years because they keep doing the same thing. Of course, hasn't improved. Does that make sense? So we do want to be more selective, but not like rigid, and so rigid and selective that we materially reduce the amount of trades that we take per day. All right. Basically, when it comes to being selective, you want to figure out if your strategy makes money or not. And if it makes money, then every trade that substantially meets the requirements of that strategy should be taken. You got it? So you want to track your results based on strategy. And if that strategy is profitable, then you want to take every trade that shows up that substantially meets the requirements of that strategy, whether you like it or not. Almost. All right. Question for you. How do you improve your Sharpe ratio? It looks like I missed some questions. What's technical analysis skills? Your ability to analyze the charts, your ability to to analyze multiple time frames, the timing with the market, all various things that go into trading. If you do relative strength analysis, so everything that goes into determining whether you should take the trade or not, that's technical analysis skills. So how do you improve your Sharpe ratio? How do you determine if it's a bad trade that needs to be cut off quickly? That's a difficult question to answer, but if the trade met your plan criteria, for most people you're better off just sticking with it and letting it stop out. For most people. Now, if the trade doesn't meet the plan requirement to begin with, then it was already a bad trade. So, okay. All right, so you improve your Sharpe ratio by taking trades with higher reward to risk. So the first step to every trade is what? The first step is figuring out whether the trade meets your strategy requirement or not. If it does, then the second step is what? The second step is you calculate the R to R, the reward to risk, and only take the play if it has an acceptable reward to risk. What's an acceptable reward to risk? It depends. The higher your batting average is, the lower the Sharpe ratio can be. The lower the reward to risk can be. If you have a really high hit rate. Okay? So it depends on the person. Some people have very low batting average. I listened to one of the talks given by Mark Douglas, who said that Richard Dennis, the guy that taught the turtle traders, had a 10% batting average. He said even 5 to 10%. But the winners were huge. When they worked, he kept pyramiding into them and rode them for a year or more. And the ones that didn't work, which were majority, he got out of for a small loss. So how do you make $100 million? Or so the claim so the story goes. The turtle traders made $100 million in a year when your batting average only 10%. It's almost impossible unless your Sharpe ratio is literally off the chart. Like I don't even know what it would have to be. 1,000 to 1. I mean, to make that kind of money. Okay? And the risk per trade would be huge. So by taking trades with high reward to risk, by improving your management, it's not just, you can pick all the trades you want with the high R to R, but if you can't manage them properly, if you're constantly getting shaken out of them, then it's not going to work. So that's tough. Now, how do you improve your management? You see what I mean? Everything takes you down the rabbit hole. Everything takes you. It's like the onion. You keep peeling, and there's more layers to it. So this is why trading is not easy. It's simple. There's only 4 things that really matter. Those are the only 4 things that matter in trading. You don't need to worry about anything else. But to get to those numbers, to get to nice numbers, you're going to need to do a lot of work. So to improve your Sharpe ratio, we said take plays with high R to R. We said improve your management. How do you improve your management? What does it mean to have a good management? It's basically ride the winners and cut the losers quickly. That's the golden rule of trading. That's really the golden rule of trading. Everybody has winners, a lot of winners. But can you ride the winners and cut the losses quickly? That's the difference. How do you do that? That's another topic for another day. And then the second way to improve your management is something that I can teach you in 5 minutes. Whether you follow it or not is up to you. In my opinion, this is the number one reason why traders fail. The number one reason why aspiring professional traders fail, which is they don't know, they're not even aware that they have a hope and fear instinct that kicks in exactly at the wrong time. I learned this from the book, my favorite book on trading, Reminiscences of a Stock Operator. On pages 114 through 115, he says, I sometimes think that speculation must be an unnatural sort of business, because I find that the average speculator has arrayed against him his own nature. The weaknesses that all men are prone to are fatal to success in speculation. He says, this is what's important. A speculator's chief enemies are always boring from within. It is inseparable from human nature to hope and to fear. In speculation, when the market goes your way, goes against you, you hope that every day will be the last day, and you lose more than you should had you not listened to hope. The same ally that is so potent to success bringer, to empire builders and pioneers, big and little. And when the market goes your way, you become fearful that the next day will take away your profit and you get out too soon. I obviously highlighted or changed the font color to tell you this is what you need to pay attention to. When the market goes against you, you hope that every day will be the last day, and you lose more than you should had you not listened to hope. And when the market goes your way, you become fearful. So when the trade goes our way, we become fearful of giving back profit. When the trade goes against us, we become hopeful that the stock goes back up to our break-even point, and we stay with it longer than we should. Fear keeps you from making as much money as you ought to. The successful trader has to fight these two deep-seated instincts. He has to reverse what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss may develop into a much bigger loss, and hope that his profit may become a big profit. It is absolutely wrong to gamble stocks the way the average man does. And he goes on to say in the same passage that he says, I've been in the speculative game ever since I was 14. It's all I've ever done. These are incontrovertible statements, and I don't care what anybody says to the contrary. I know these to be true. And when I read that, I was like, wow, this guy is emphasizing something here. And I could tell there was some insight being shared, some truth, whatever you want to call it. But I couldn't figure it out. Like, what's so important about these statements here? Until much, much later. And, but I knew already, and that was way back in the day, like before I even went full-time in 2007, is when I read this passage. Later on, I read Trading in the Zone by Mark Douglas, and he really helped me basically, and between the two of them, I figured out what Jesse Livermore really meant. So let me show you what he means. When the traders are operating out of fear, let me tell you something. When a stock goes your way, you always operate out of fear. So check it out. This is a buy setup. Okay? This is a buy setup pattern. Entry, target, and it's not a target yet. Is it a target? Is it? Not yet. Should you take it? Should you hold? I thought the rule is to hold the winners. What about now? What bars are you now more focused on? The red bars or the green bars? What bars do you pay more attention to all of a sudden? What bars, immediately catch you off guard? The red. Why? Why is that? Why are you paying an inordinate amount of attention to the red bar now? Because you are afraid of giving back profit, right? So when the trade goes your way, you're always going to be fearful, operating out of fear of giving back profit, which Jesse Livermore says makes you get out too soon. So in this example, let's say you didn't get out because it was in your favor, you're trying to hold it, and all of a sudden now it gets down to break even and you start kicking yourself. Oh my God, back to break even, gave it back, and then you get out maybe because it's break even or so. Maybe you even lost a little bit. Okay. All of us. This is why people ask me, should I raise my stop to break even once I have an R in the money? And I say, no, the market doesn't care about your break even. So, and then you don't, realize, oh, you got out right at the rising 20. The trade goes right to target, in fact, above target, but you're not in it anymore. So what happened? Can someone, in their own words, explain to me exactly what happened with this trader? What happened? You know what happened? Right. Fear of giving back profit. Maybe when it got down to break even, fear of losing also. You're right. Got you out of the trade. But I will tell you really what happened. The trade made money available right here. The trade was in the money. But you decided not to take the profit, the small profit, which is fine, because you wanted to hold for the real target, right? But you weren't able to hold, and ended up getting out late. Or if you wanted to hold but didn't hold, you made a mistake. You didn't wait for the pivot in this case. So when you said you were going to hold, you weren't able to hold. And when the trade made money available to you, you didn't take it. This is what I call the in-between management. You're not too tight, you're not really tight with your trail, but you're not laid back enough. You don't give it enough room. The insidious thing about fear is that it narrows our attention onto the object of fear, so that we end up doing the same thing we're trying to avoid losing or giving back profit. In this case, that's exactly what we end up doing, giving back profit. Okay, now let's say the trade went against you. When the trade goes against you, after a while, if you've been at this game for a while, you'll realize that if you don't take your losses, you'll go bankrupt fairly quickly. You'll go bust fairly quickly. So a lot of people do take their losses quickly. I mean, they exit their trade when the trade stops out. But believe it or not, there's some that don't. And if you didn't exit, why didn't you exit? Why would you still be in it? Clearly went way against you. So why would you still be in it if you didn't exit? Anybody? Because, you're hoping that it goes back up. Hoping for what? For a green bar. So now what bars are you more focused on all of a sudden? The green bars or the red bars? It's whatever bars give you hope. When the trade is against you, when we're in a tough situation, we start hoping. That's real life. If we don't hope, we'll fall into depression. I'm sure it's a survival mechanism. So if you're hoping, if you're in a bad situation in life, hope is your greatest ally. If you're in a bad trade, hope is your worst enemy. It becomes hopium, not hope. So, because then it keeps you in losing trades longer than you should had you not listened to hope. That's what Jesse Livermore said 100 years ago. And and then it continues lower, and you're still in it because obviously you're hoping for another bounce, and now you finally got it, and then it continues lower, and then when you get out of the trade, you feel shocked, petrified that you never even noticed the downtrend. Again, fear limits our perception onto the object of fear, making everything else is invisible. I am not making this up, but when I would get out of the trade, at the end of the day, I would look at the trade and say, oh my God, I can't believe I didn't even see the downtrend. How? How did I not even see the lower highs, lower lows? Lower highs, lower lows. That's a downtrend. Why did I stick with it? Because I was just focused on the green bars. Was just hoping and praying sometimes for a bounce back up to break even. So Jesse Livermore said, when the trades go against us, hope kicks in. Which is, again, the last thing you want. When the trades go our way, fear kicks in, which is exactly the opposite of what you want to do. He says you want to reverse these, what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. That's what he said in that passage that I read to you. So now I know what to do. Now I know what to do, which is what? Now I know that when the trade is going my way, I have to watch out for fear. Now I have to be mindful that fear is going to kick in, because I'm going to be afraid of giving back profit, and I can't let fear be the determining factor as to whether I stay in the trade or get out of the trade. And the same goes for when the trade goes against me. I can't let hope keep me in it longer than I should. I have my stop, and I need to honor my stop. I can't let hope keep me stuck in it. Now, it's if you use stops and you have stop orders in the system and you never ever cancel them, you don't have to worry about hope. But every single person, myself included, everybody goes through the experience of, or experiences that emotion that fear emotion of giving back profit. Everybody. So our job is to become aware of it during the trade. Now you're aware of it. But are you aware? Are you going to be able to be aware of it in the middle of the trade? That's the tricky part. Got it? So make sure that going forward, when you're in the trade and it's going your way, that you keep in touch with yourself and make sure that you don't let fear take you out of the trade prematurely. Just make sure of that. Trade gets to target, trails out, no problem. But don't let fear be the deter. Don't let fear get you out of the trade, or hope keep you in the trade if it's going against you. Okay. This is why it's often said that traders eat like birds and crap like elephants. When they make money, they make very small money. When they lose big money, because hope keeps them in losing trades longer, right? Than they should had they not listened to hope, and vice versa for fear. Okay, and this, my friends, is again what I call the in-between management method. It's truly the most common mistake that I see people in this room, in every room that I've ever been a part of, make, which is what? This is it. They say, well, I want to be disciplined. I want to hold the winning trades longer. I mean, stick with them until they get to target or whatever. But then they can't hold. When they say they want to hold and they want to be disciplined and they don't want to get out for the small money, they want to hold for the big target, they can't, because their fear becomes worse and worse as the trade goes against them. Not only is their fear being realized by giving back profit, but now their fear of losing money becomes, this trade is now maybe even negative a little bit, or break even. So when they say they can't hold, when they say they want to hold, they can't hold. And when the trade makes money available to them, they don't take it on the first sign of reversal. So should you exit on the initial, did the trade make money available to you here on this initial pop? Yes, it did. Was it as much as you had hoped for? Maybe not. Should you exit on the first sign of reversal? Should you not? It depends on your strategy. It depends on your personality. Okay? It depends. You do your tracking and see what's better. But it's not just your tracking. It's also, are you able to hold? Are you psychologically able to hold? Are you not? You see what I mean? So the in-between management is, again, not trailing really tight, but not trailing also really loose. It's in between. So you don't get out right here, you get out right here. Or you don't hold through all of this and then get out at the top. The trader that, the scalper type traders that make the small money can be profitable. The traders that like to hold for the big target can be profitable. The traders that do in between, they're not tight enough, they're not loose enough, those can never make money. Take it from me. So here's the rule. Take the small money the market makes available, or hold until the real target is reached, but don't make the in-between management mistake. Does that make sense? So figure out whether you're a scalper type of trader, or you're more of a buy, you can hold. Figure out also what's better based on your strategy, based on your tracking, the tracking for that strategy. And then implement a management policy that puts you in a position to win. That's best for you. Again, based on those two factors, your psychology, your personality, and your tracking, your data. Figure out what works best for you, and then be very religious about it when it comes to implementing it. Like, especially in the beginning, don't deviate from it. Okay? This, my friends, again, is the number one killer of traders. I'm not talking about novice traders, completely novice. I'm talking about you. Talking about the people that are trying really hard to make it work. They seem to make money, but then they can't sustain it. It's not, they don't make enough, or they're always hovering around break even. If I had to guess, this is your mistake. There could be other issues. Could be just really not good enough when it comes to technical analysis, but you think you are. Most people, they really overestimate how good they are. I know, I'm sorry to say that, but most people really overestimate how good they are. Or maybe you're, whatever it is, but this is the most common mistake that I see. Another thing too that really helped me when I was trading was to become aware of the issue that the money, the P&L play, the impact that it had on me during the day. So I would routinely hide my P&L, my profit and loss window. I would routinely hide it because it influenced my decisions to get in, to influence my trading decisions, and I don't want to do that. This is called dollar counting, or whatever. So here's the quote: when an archer shoots for nothing, he has all his skill. If he shoots for a brass buckle, he is already nervous. If he shoots for a prize of gold, he goes blind. He's out of his mind. He sees two targets. His skill has not changed. He's still the same archer, but the prize divides him. He cares. He thinks more of winning than of shooting, and the need to win drains him of power. Wow. I honestly read this in a spiritual book long time ago, and I don't even remember which book, but I thought, wow, this applies exactly to trading. When I'm attached to a certain P&L, it just doesn't work. Never does. If I say to myself, I need 5 hours, otherwise I'm going to continue to trade, or otherwise I'm going to continue to take trades, it never works. If I'm attached to a certain P&L, or if I see, I'm down on the day, then it messes me up, then yeah, that's why, because you're attached to the P&L. So your attachment to the P&L is a huge deal, huge problem. I'm not saying you should hide your P&L during the day. I did it for a couple of years almost, until now it's not as big of a deal. But I am saying you should pay attention to it. Okay? And that's it. And I hope you enjoyed it. I know that if you're a regular room member, you've seen me go through this before. But if you're new, this is like the single most important lesson I can share with you. I don't think there's anything more important. I just talked about the 4 things that impact your trading. The only 4 things that matter in trading. That's the title of the presentation. I talked about the most common mistake, which is the in-between management. I talked about what happens to your psychology, to all of our psychology, when we're in a trade, depending on whether it goes in our way or against us. So those are like the most important things that we can talk about. So I hope, I know it's not the sexiest topics. I'm not bringing up charts and showing you these incredible indicators and swiggly moving averages, and but this is the single most important discussion I can probably have with you if you're new to trading. So I hope you take it to heart. All right. Thanks a lot.